that was one of the reasons we decided to develop, is because not everybody can do it. With all the different gurus and programs that have come up and just success of real estate in the last 5 years, most intelligent people can go in and do a value add on a multifamily. Most people don't have the knowledge or the connections to do a development. The development returns are better. I think hands down, all of our developments have proven to be a lot more successful from a return perspective than the value adds.
This is episode number 04 of the Multifamily Success Stories podcast. Would you like to turn vacant units into cash and earn up to 3 times more per door without having to do any extra work yourself? We offer fully managed short-term rental solutions for multifamily investors. Go to managedbylux.com for more information.
Hey, this is John Bell
And Julian Sage.
and welcome to the Multifamily Success Stories podcast. This is a show where we talk to multifamily investors about their journeys and starting and growing their real estate empires.
Our goal is that you'll be able to walk away not only inspired, but with practical information to help you in your real estate journey.
Since we are a new show, please go over to iTunes and leave us a review and let us know what you enjoy.
And if you haven't done so already, go on over to our Facebook group, the Multifamily Success Network, to connect with the community. Hey, what is going on, deal makers? Julian Sage here, and I am very excited for this episode because today I had the honor of speaking with Sam Bates. Sam is the co-founder of Trinity Capital Group, an investment company that focuses on developing and acquiring properties in the Texas and Mississippi area. Trinity Capital has 482 units operating and another 320 under construction, totaling $75 million under management. In this episode, Sam shares his experience of starting out in the multifamily space, how he built his team, and why he focuses on development as a way to distinguish his company. If you like my show notes for this episode, go to multifsuccess.com/EP04. Or if you like my show notes sent directly to your inbox every week, then go to multifsuccess.com/show notes. With all that being said, on to this week's conversation. Hey, welcome back, everybody, to another episode of Multifamily Success Stories. In this episode, I have the special honor of speaking with Sam Bates. Sam, would you please introduce yourself and let everybody know who you are and what inspired you to get into multifamily investing?
Yes, thank you, Julian, for having me on the show. And it's an honor just to get to share my story, and hopefully some of my knowledge that your guests find will suit them well in the multifamily space or just in life in general. I think what got me interested in the multifamily space was, even in undergrad, I was a finance major, and I thought about getting my master's in real estate directly after I graduated. And during that summer, I got an internship with UBS Financial Services, and it led into a job, and I was a financial analyst with them for a while. And then I moved back to Dallas, and I was at a consulting company, and it was a job that I just did not enjoy at all. I was working all the time, and it was doing sales and use tax accounting, and it just didn't excite me. So I started researching again and figuring out how I could get out of the rat race, per se, or get out of corporate America. And I kept coming back to real estate. And at that time, there weren't any or many podcasts available, and there wasn't this vast knowledge base that the internet has of real estate. So I started reading and doing some research, and I came across an organization that helped mentor people and provide education, and they did single family and multifamily curriculum. So I just started learning from them, and my first venture into real estate was as a limited partner in a 208 unit multifamily deal. And then I did a lot of single family from 2010 to 2014, and then realized to be able to scale and get to where I wanted to be, multifamily was a better option. And that's what truly led me back into multifamily and actually being the GP and running deals on my own.
So it was after that time in 2014, after doing about 4 years of single families, that you decided that you were ready to move over to the multifamily space?
Yeah. From 2010 to 14, I did 17 or 18 single family deals. And I used my own capital, and initially in 14, I thought I was going to just buy a small multifamily unit. I looked at a few that were 10 units. I looked at some all the way up to 30. And then I ran into now one of my partners who we used to work together at a consulting firm. I ran into him and he was looking to do the same thing. So we decided to partner up and try to find a deal together. Long story short, we wasted about a year and a half and we never got a deal under contract. I think some people thought we were too young to take us seriously. Other factors, I think we underwrote the deals too conservatively. At that time, people were saying the market was kind of at the top or a few years out. And so after spinning our wheels for a couple of years, he reached out to one of his contacts who had been a developer for, at that time, about 20 years. And he was developing a commercial building for himself to lease out to a couple tenants he had placed, but he had never done any type of syndications, didn't understand how to raise capital, how to structure the deal. So we three came together and it made sense. And that's kind of where our company formed.
I want to go back because you said that you got started in around 2010. You had this finance job and you were kind of tired of the rat race, you said. I mean, 2010 was a pretty chaotic time still. You know, we just were coming out, you know, still at the tail end of that Great Recession. What made you think like, okay, right now is the right time to actually start getting into real estate investing? Because, you know, right now it's a pretty scary time for a lot of people that are interested in investing. You know, people right now, they're thinking, oh, well, you know, they just had that realization. Maybe they just read Rich Dad, Poor Dad. Maybe they just started listening to Bigger Pockets or one of the multifamily podcasts. And they're saying like, you know, right now is the time. But it's scary. There's a lot happening in the market. I don't know if right now is a good time. What made you say like right now is the time?
Well, and to go back to 2010, well, just for my entire career, I actually stayed in a corporate job until end of 2017, beginning of 2018. So I did all this on the side. Part of it was I have my own personal insecurities with money and just finding security through money. And I never felt like I could leave a corporate job without being kind of financially set. So when I was investing in 2010, it was all on the side and I had a steady stream of income. But I think what was the driving factor is a lot of people talk about their why, and you have to have an important why. And mine was I didn't want to stay in corporate America for 30, 40 years and look back at my life and realize I didn't enjoy what I did over that time. And I've always been an analytical guy. I've always enjoyed numbers. And my mind just gravitates towards that. And from an underwriting perspective, when I would underwrite deals, I would light up. And really from 2010 to 2016, I was working, I don't know, 50, 60, 70 hours at my corporate jobs. And then I would do real estate at night or on the weekends. And I don't know how many hours I put in, but it just gave me that extra boost or energy to keep going. Where I also have to say, like, yeah, you can have a great life, you can make some good money, but every deal I've ever done, there's issues, there's problems that you have to solve, you have to correct. And if you aren't passionate or you don't enjoy real estate, you're probably going to fizzle out. So if real estate's not your cup of tea, I recommend you finding that passion that you can work the long hours, and it feels like a hobby a lot of times.
So you kept your corporate job throughout these years just because of you wanted that stability, and you were also doing this more on the side as something that you were passionate about. Can you talk about some of those first deals, like those first baby steps, and some of the challenges that you had to overcome when you started?
And are you talking about on the multifamily or just single family?
Just when you got started into real estate.
Okay. The first deal I invested in as a limited partner, it was back in 2008 through even really 13, 14, when you had a true value add, you would go in and you might not see cash flow for a year and a half, 2 years, 3 years. And on that deal, we had a sponsor who had a lot of experience, and we bought in a neighborhood that we felt like was really good, and the submarket is really good, but the specific location is kind of a war zone. And we had to go through two property managers. One of the property managers was the sponsor's company. He removed himself. We brought in a third party. We had to remove them. And in the first couple of years, it was a struggle. We had shootings at the property. We had a lot of different things that going into it, I think most people didn't expect. And once we removed the GP, brought in a couple of the limited partners who became the GP essentially, we were able to turn it around. But it was also just market timing. And I mean, we bought it for, I think, 17,000 a unit. It's now trading probably around 100,000 a door. So a lot of it was market timing to save it. On my first single family purchase, I was in the process of closing. I already picked out a contractor. Well, the contractor decided to go to the house before it closed, and he started to tear it up. And in that time frame, we found out there's a slab leak and some other issues that I wouldn't have actually went through with the purchase if the contractor went over there and basically broke into the house and started renovating it. And I'm thankful he did. At the time, it was very stressful. But if I would have known about the slab leak and all that before he touched it, I would have backed out the contract. And that just prolonged me onto the journey, I think. And that house has turned out to be a great purchase. Part of it was a great neighborhood. Part of it is just the market over the last 10 years has increased the way it has. So you're always going to find issues like that. But if you are in real estate for the long game, you're going to do a lot better than I feel like most other investment opportunities.
So it's pretty interesting because you started off with multifamily investing as an LP, and then you transitioned over to the single family space, but then you came back. So what happened during those 4 years? Did you enjoy what you were doing? Did you make a lot of, were you profiting and that's what kept you in there?
Well, when I transferred back to single family, I felt like I wanted that control. And when I was at LP, I had absolutely no say in any decision. And I started the LP route because I didn't have a lot of free time. But then I realized if I'm going to leave my financial future up to myself, or I'd rather take my financial future by the reins and control it than some other person. So that's why I got back in, or I started doing single family, because I didn't have the capital or the network really at that time to do any large multifamily deal. So then after 3-4 years, I realized I had the capital to go and buy a smaller multifamily. And I just felt like I could scale a lot easier because, I mean, closing on a 50 or 100 unit deals, I won't say the same amount of work as closing on one single family, but you're going through the same process and it's not that much more difficult. So, and I think it's a lot easier to raise money from a limited partner when you're saying, hey, here's a 50, 100, 200 unit portfolio or just apartment, compared to I want to create a fund and buy single families as they come along. You don't know if they're going to invest with you. They're going to have a lot more questions than when you can show them one asset instead of potentially 100 or 200 single family homes.
So what do you think was kind of the tipping point in your single family real estate career? Did you feel like you were just like burnt out, or did you feel like, you've had enough of trying to take control of everything? Because it seems like you're doing a whole lot, even with your new, with Trinity Capital.
Yeah. I don't know if there's an ever like one moment or tipping point that was like, okay, I'm going to do multifamily. I think just from an economies of scale standpoint and also a capital raising standpoint, it made sense. And I know some people that stay in single family their entire life, but there's a lot more facets, I think, to multifamily. And I feel like my skills I can utilize better with multifamily than just buying single family. I think they both have issues. And I mean, I'm constantly working with Trinity Capital, and we have a lot of things going on, but I'm still working 50, 60, 70 hours a week, and I enjoy it. Some people want to get in multifamily and sit back and be hands off, but we've learned if you become hands off, the third party property manager is going to become more hands off, and they aren't going to, well, from the get go, they don't care as much about your asset as you do. So if you aren't on them and always questioning them and always talking to them, they're going to easily stray. And I think that's just human nature. If you aren't being pressured, you're going to stray and let it possibly drop the ball.
What was the most challenging part of starting Trinity Capital?
I don't know if there was any one really difficult part to starting it. I think the first project we did, like I was saying, it was 10,000 square feet retail space with 60 unit apartment building. And we didn't know if it was going to be just this one project or if it was going to parlay into others. And for that project, we had to raise over 2 million, like 2.2 million. No, none of us had ever really raised money. And I think we had a track record from business performance and from our single family properties, but we didn't really have any type of multifamily experience. So getting people to actually trust us by turning over $50, $100, $200,000 checks was difficult. But once we picked up momentum, the capital raising has been a lot easier than the first time around. And honestly, now that's obviously that's always a concern, but we haven't had any issues raising capital for any of our projects since. It's just we've gotten to know our investor base a little bit better, and we know what they want and like. And like we have a property now in Mississippi, and from all the underwriting, from the performance since we've taken it over, it's going to be a home run. And that one, a lot of our investor base is either Texas or New York, and they just were afraid to invest in Mississippi because the connotation of Mississippi compared to where you can invest in other states. But it's a great asset, and we'll probably hold it for 5-10 years at least.
How did you build up that credibility? Because you said, when you first got started in the multifamily space, you didn't have any experience with raising capital, and asking someone to sign over a $200,000 check is no easy feat. So how did you position yourself to be able to say like, hey, I'm the right person for this, and this is the right deal. This is why you should trust us?
I think there's several factors that go into that. On that first deal, it was pretty much all friends or business relationships that we've had in the past. There's a couple family members, but distant family members that put in their money, and they'd seen our performance and track records outside of business. And one of my partners, he's a CPA and he owns a Chick-fil-A. So I think being a CPA, having a Chick-fil-A, that brings instant credibility. I have 2 master's degrees. The third partner, he's been developing houses and other commercial developments for 20 years. So we hadn't raised money, but we were very capable and trustworthy people. So I think that was easy for people to hand over the capital. And then like it was a mixed use deal, but the commercial 10,000 square feet of retail space was in front of the apartment. So we sold the retail space basically a year after we finished developing it for tax purposes. And we provided the investors a 41% IRR. So as soon as we got that track record, it made it a little bit easier. And even during that time frame, we had started on another development. So we had started growing kind of from day one once we realized we worked well together as a team.
And where did you find these people that trusted you and that would want to invest their capital into your projects?
I think, like I was just saying, it's been mainly connections we've had over the last 10 years, 15 years. Now, even on some of these newer deals, like more family members are starting to invest. Some good friends of mine, particularly, have invested. So it's just the network. I've been networking in DFW now for 10 years. And I mean, some weeks I go to a networking event every night. So it just my network's grown, and that's helped helped raise the capital. And one of my partners, he's very good at raising capital, and he has a deep network, and it's just flowed from there.
What's been your biggest real estate failure, and what have you learned from it?
That's a good question. I feel like I have failures every day and things I learn from. One of the house flips I would probably consider as my biggest failure. And it was, I trusted a contractor too much. I gave him 50% of the money up front, and he started the renovation process, and it was a burned down, it was a burnt house. So we basically had to build it from almost ground up. And he started that process, and we went through it. And even the bank I was using, they signed off on the draw request. And I was like, okay. So I gave him another like 25%. And as soon as that happened, he never answered my call again. So I think it was just trusting and not completely verifying. At that time, I was still in consulting and working a lot of hours. So I trusted the bank inspector to verify more than I probably should have. And after he left and never returned my call again, I realized that a lot of the work he had done, he did incorrectly. So I had to hire another contractor to come in and basically redo a lot of the work he had already done. So it just was I don't know if it was a turning point, but it just made me realize I can't trust anybody, and I have to rely on my instincts and just my eyes. Or like with my two partners now, I've been working with them for 4 years, and one guy I've known for a decade. So I can trust them, but anybody else, I'm not going to just take their word for it.
And what were some of those tiny, you said you had little failures along the way. I think when people listen to a lot of other investors in the space, they think, man, these guys have just got it all together. They have the systems, they know the people, they're able to knock out everything. But you're saying that, every day you have these little failures. Can you kind of explain those?
Yeah, well, I think any company that's starting out, you don't have the processes in place. And we've built processes over the last 4 years, but even this year, we took over one of our properties that we have because the property manager wasn't doing a good job, and he stepped down. And it's in a more tertiary market, and we felt like we could do just as good of a job as anybody else. So putting those processes in place, bringing in people, the property manager that was on site, they were doing an okay job, but they luckily stepped down because we were going to have to replace them anyways. And just things like that. A lot of the failures is just human interaction, and they're, like I was saying, is they aren't going to care for the property as much as you. So just always staying on them. We're trying to take more control and be more hands-on, and I'm sure some of the property managers don't like that, but we've had issues with almost all of our properties at one point in time, and we feel like to be the best stewards of the financial resources our investors have given us, plus our resources, we need to have a more hands-on approach. And so now I'm at some of our properties every week. So I have calls with our property managers at least once a week. Some of them I'm talking to multiple times a day through email, a couple times a week over the phone. So just making that presence being felt, that they can't slip up, that I think has changed the trajectory of a lot of the properties, or will change in the future.
Do you think that multifamily investing is really a passive income, or from what it sounds like, what you're saying, it's like it takes a lot of work. You gotta make sure that they're not messing up. You're making sure that your passive machine is still trying to operate.
I think it depends. Obviously, if you're an LP, it can definitely be passive. And I think if you go in and buy an apartment, it can be more passive than some of our investments. I mean, more than half of our portfolio we're building from ground up. So we have to be hands-on with all the construction crews. We leasing up a property from 0 to 100 is a lot more difficult than trying to move it 5 or 10% in occupancy. So from a development standpoint, it's going to be a lot more or a lot more active than somebody going in and buying a 100-unit apartment that's at 95%. So I think it just depends on a lot of factors. And I know I've talked to some operators that do the value adds or the properties that are already stabilized, and they're 100% hands-on. They have the weekly calls like I do, and then I know others that are a lot more passive. They might have a larger nest egg. They might be later in their career. So it kind of just depends on, and it's your personality. Some people want to work all the time, and some people want to relax on the beach. So it fits your personality. But I would say to do it well, you have to be active in it.
And what made you want to go the development route? Because it sounds like you had a pretty scary, a rough start with trying to do, contracting work yourself. But now you have over 320 units under contract, and you're dealing with a lot of moving parts, and trusting, having to trust a lot of people, trust but verify. What was that? What made you transition over to this style of management development?
It was, I think, two key factors. Spending that year and a half to 2 years trying to get a deal in DFW and never getting one it made Michael and I both come back and just self-assess and see what we were doing wrong, how we could improve, how could we get outside of the box. And even in 14, 15, there was a lot of people and some groups, but it's not the level that it is today with competition. And we're like, okay, if we can't get a deal now, we need to reassess. And that's when we brought in Daniel, who had that experience. He already had his contractor crews. He already had all the processes in place where we could build. And I don't really focus on the building aspects of our developments. I underwrite. I help with some of the development, but I'm not doing the nuts and bolts. So I'm never going to pick up a hammer. So having a partner that I can trust was the other key step. And if for some reason our partnership dissolved or Daniel wanted to retire or whatever, I probably wouldn't get into development again until I found somebody that I could truly trust. And I think trust comes in a lot of factors. I think you need to have common beliefs and a value system, because it's going to depend on the marriage. I mean, you might know more intimate details about your partner than their spouse, which I hope is not the case, but it's like a marriage, and you have to wholeheartedly trust them and know their background, know their history, know their financial statements. So once you realize and learn that, I think it's a lot easier to move forward with somebody and I've heard some people will get into a partnership after one or two meetings, which that would scare me to death because you don't know how they're going to react in certain situations.
Does being in the development space scare you at all with everything that's happening in the market? Do you feel that it's a riskier move being a developer than just a person that is, trying to do a value add?
Yes and no. It is riskier from a standpoint of from getting the land under contract to going through zoning. If you have to go through zoning to the final completion, it can take 2-3 years. So there's a lot of change that can happen in a market. And there's just a lot more risk because there's a lot more upfront fees. You have to pay for architecture, engineering, all kinds of different third-party sources that you never have to pay for from a value add or from an acquisition. But at least where we develop only in Texas, and Texas it's obviously one of the top population growth, top job growth. There's 400 people moving to DFW a day. I heard at one point in DFW, Houston, and San Antonio, there's 900 people moving here a day. That was a couple years ago. So there's always going to be a need. And right now, the demand can't meet that need. And with single family construction, the cost of labor, cost of materials keep going up. So obviously the housing prices are going up. So a lot of people that used to be able to afford a single family fixer upper or starter home can't afford it anymore. So there's an apartment demand. So from that standpoint, I feel safe and secure because we're being able to bring a brand new apartment to market for what a lot of people are paying for a 1970 apartment. So from just a cost basis, I would much rather have a brand new apartment at the same cost basis than a 1960, 1970 product that somebody just bought and has a lot of deferred maintenance or just mechanically and from an efficiency standpoint, it can't match with what we can offer.
How do you, I feel like maybe running the numbers, and analyzing a deal is quite different from a development standpoint than, just like a value add where, you're acquiring another property. What type of process does it take to be able to build a property versus just, finding something that, you got to replace the shutters and, give it a paint job and, improve the management?
Yeah. How we've structured our company is we have a set price with Daniel, who's the developer, with his other development company. So luckily from that standpoint, we can pitch a set price to our investors. We know if costs on his side either go up or go down, we're still protected. And it's a hedge that we decided from the get-go to put in place just to be able to give the investors a peace of mind that, hey, we aren't going to have to change the pricing. But it is a lot more difficult. And one thing in one of our newest developments is the city promised us that they would pay for a road. And at the end of last year, they decided not to. So we had to scramble for $500,000. So there's a lot more contingencies and a lot more underwriting that you have to put in place and think about than you would on an acquisition. But once you kind of figure out the construction cost and hopefully get that nailed down, it's pretty similar. In Texas and I'm sure in some other markets, property taxes and insurance have skyrocketed over the last couple of years. So, and those are two of the biggest, I feel like, deal killers with acquisitions. And from a development standpoint, it's a little bit different because, or at least the land we take is usually ag land, so we have to pay rollback taxes. And luckily, through that time frame, the property tax base is going to stay pretty low. But once we're fully occupied, we know it's going to skyrocket. Same with insurance, same with utilities. So there's a little bit more playing around with the numbers. And for 1 year or 2 years, obviously you aren't going to make any income. Maybe in 3 years, depending on how long the job is. So it's more technical than just saying I'm going to buy a value add and it's going to be cash flow in X by purchase price or 6 months. There's more variability, and also it's a lot easier to miss your target than it is on an acquisition.
And what class properties are you guys developing?
Well, all the properties we've developed are in more secondary and tertiary markets. They're in smaller cities outside of Fort Worth. So our first development was in Kerrville, but the rest have been close to DFW. And I would say they're Bs. One of them that we're developing is an A, but if we put in like downtown Dallas, it's not going to hold up to a brand new A-class property that Trammell Crow is building. But it's the nicest property in the locations where we're at.
And have you kind of found like a sweet spot, or is it like you're, because if you're going from like A's and B's, are you also looking at some of those C-class properties as well and looking at trying to, develop in those types of areas?
No, we haven't. The oldest property we've bought is a 96. And when I underwrite, I've looked at some 1970s, 1980 product, but I like the newer products for a lot of reasons. But we're never going to develop a C. It's just, it doesn't make sense economically, and from just, I guess you could develop in a C neighborhood, but you aren't going to put C quality product into a brand new project. So, and we've never built in a C quality neighborhood or class neighborhood. We've looked at it a little bit and looked at some LIHTC options, but it's just never appealed to us. I'm not saying we won't do that, but we tend to invest in more affluent areas where we can get the 14, 15, $1,600 rental rents per unit for an area. And in the smaller areas, that's a lot of money for different tenants. I mean, some mortgages in those areas don't even cost that much. So it's something that we've just considered with rent growth, job growth, and just wanting to build areas where we have a good tenant base.
Do you feel that the payoff is better for developing and it's maybe easier than, let's just say, like value add? Because I feel like a lot of people in the space just try to go from the value add perspective and, trying to do some type of like arbitrage, like, oh, here's a sweet deal. If I just put in this amount of work, I can, get this much out. But if you're developing, it's probably a much smaller pool. What are your thoughts with everybody else that's in the multifamily space and what you've decided to pivot to?
Yeah, and that was one of the reasons we decided to develop, is because not everybody can do it. With all the different gurus and programs that have come up and just success of real estate in the last 5 years, most intelligent people can go in and do a value add on a multifamily. Most people don't have the knowledge or the connections to do a development. The development returns are better. I think hands down, all of our developments have proven to be a lot more successful from a return perspective than the value adds, but they're more risky. Like I was saying earlier, there's more things that can happen. Construction can get halted for zoning issues, for weather issues. There's a lot of things that can put the project on hold that you'd never have with a value add. So with that inherent risk, you should be getting higher returns.
Would you stick with the development track, or like if you were to go back into, let's say you lost your developer partner, would you go back to doing value adds or try to do something different in the multifamily space?
I haven't really thought about that. I think if I lost my partner, I definitely have to consider just value add. But at the same time, I have a large network. I can meet some developers and maybe they can develop property but don't understand other functions, and I can bring that and maybe we can go that way. But we feel like we have a, I won't say competitive advantage of over people, but we feel like where we're building, there's not much competition. And we don't want to change that until either the market's turned and there's not demand for it, or we've ran out of land where we're trying to build. And maybe we'll hit that one day. But I mean, we aren't building 2,000 units a year. After we finish these two, we'll be at 800 to 900. So I think we can do this for the foreseeable future, taking down 1 or 2 deals a year.
And is this your full-time thing now, where you're just focused on the acquisitions of these of this? So you're basically just acquiring the land and you're evaluating it based off of other properties, other like comparables in the area, and then saying if we spend this much on development, we can get this return.
Yeah, this is my full-time job really since 18, and I wear a lot of hats in our company. I handle the acquisitions and dispositions. A lot of the investor relationship piece goes through me, and then one of my other partners also handles investor relations. I oversee almost all the operations and we third party all of our properties except one. So I talk to our property managers, handle the banking, treasury, legal. Obviously, I'm not writing up contracts, but I'm talking with the attorneys and things like that. So there's no way I could have another job and do this well. So I don't know if that'll change in the future. And we've brought on 2 employees this year, and we have another employee. So, and we're looking to grow. So I'm hoping to be able to replace part of my job with an asset manager or even just an assistant to do a lot of the day-to-day stuff that I don't have time for. But yeah, I've found most of our acquisitions and land, but Daniel, who's the builder, he has connections, and like the last piece of land that we closed on in December, he had a realtor bring it to him. And it was a great piece of land and we think we can do really well on it. So we decided to move forward.
What do the numbers look like for someone that's interested in development as opposed to just value add? Like, you have three partners. One of them is the does the developing themselves. What does the payout look like? Are you saying like, oh, if we find a $3 million or whatever the amount of property, I'm going to be able to get this much for myself and then this much for our investors? Like, how do you even like say like, all of this work, all of this time that I'm investing is going to result in this payoff, which is, worth it?
Honestly, it depends on the project. We've had like our first development deal around Fort Worth. After the refi, we had one partner in it and we returned 100% of his capital and our capital into the deal. And now we've just been cash flowing since. On the latest development, we are doing a 50-50 split with a couple people, and we feel like we can return them 30 to 40% IRR conservatively over a 10-year time frame. And those two deals were pretty easy to model out because there was a lot of comps. We just finished with one development in a little smaller area. It's 30 minutes from Fort Worth, but the population is like 4,000 of the city. So it was definitely harder to model out. And we had a partner that had done business with us in the past and trusted us, and they wanted to do it. And we're in the lease up phase right now. And we've actually been collecting higher rents than pro forma, but the lease up is going a little slow. So I don't know exactly how we'll turn out with that, but we still feel like we can return 100% plus of their initial investment and then cash flow from day one. So on a lot of those type of investments, we're projecting anywhere from a 25 to 40% IRR to the LP. And that's not total return. On some of our larger syndicated developments, we've projected a 20 to 25% IRR to LPs over roughly 5 years usually, which I feel like is a pretty good return for just giving us the money and letting us do all the work.
And you typically sell these off at the end. You don't hold on to them long term?
No, we've actually kept all of them except one. We sold off the commercial retail space, but all the apartments we still have in our portfolio. Eventually, I think we're going to sell off, but right now, they're all new assets. They're all in pretty good locations, and we think they'll be good long term. And we also base it, especially on the smaller deals where we do JVs, we base it also off on our partner. But on the syndications, we feel like we do whatever we think is best at that time. Like one of them that we built, we refied, I guess, in 2019. So we have a 10-year CMBS loan, so we're going to hold it probably close to that 10-year time frame. Another one we're doing right now, we're going to refi and do a second phase. So we'll have it for at least 5 or 6 years and then probably sell off. And then a couple of them we might hold 30 years. So it just kind of depends on the investors and just different scenarios of each property.
What's the biggest mistake that you see new real estate investors doing?
Everybody talks about underwriting, and you could obviously, if you don't underwrite correctly, it's going to kill a deal. Like I actually analyzed the deal yesterday from somebody who graduated from Ivy League school, who's had a lot of experience in single family. And I looked at the underwriting model and it was complete garbage. They didn't increase property taxes. They didn't increase insurance, and it was a deal in Houston, which insurance rates have skyrocketed, especially in Houston. And there was a lot of other things that were wrong with it. But I feel like from a lot of the properties I've toured over the last couple of years, I think being undercapitalized. And right now with COVID hitting, you're going to see, I've had quite a few brokers reach out to me and say they expect deals probably September timeframe I've had a couple already say that they've seen a couple distressed deals they're trying to get rid of right now. And it's because they were undercapitalized or they couldn't get the rents that they projected, and they aren't meeting the return requirements that their investors expected. And I think it's because there's so much competition, people are overpaying. Like, we've still yet to buy a true value add deal or just an acquisition deal in DFW proper. And I've put in, I don't know how many offers. And like last year, I underwrote 170 deals and didn't get one. So maybe my underwriting's too conservative, but I feel like now that there might be a correction or a downturn, a lot of people are going to be hurting.
And do you feel that you'll be safer because you're in the development route?
At this point, I do. I'd honestly never felt that way. But I think COVID showed a lot of weaknesses in the economy, and a lot of people said workforce housing, blue collar housing is always safe. Well, this time around, it showed that Cclass properties are collecting less than the A and Bs. And that might not be true for the entire next few months, because I know there's some A-class white collar jobs layoffs that might affect the A-class properties. But I feel safe with developments. It's a new product. We aren't on the high end Class A developments like the $2,500 a month rents. So I think they might struggle. But where we built, we're one of the only developments, or we don't have much competition. So there's going to be enough demand for people to want to be there.
What would you do differently if you had to start from scratch?
I think if I had to start from scratch, I would have went more with my gut and not just relied on other people's advice. Especially early on, straight out of school, I was listening to a lot of people who had been in business and a career for 30, 40, 50 years. And some of them were my family, some of them weren't, but they were like, stick with your good job, stick with just that safe paycheck. And I wish I would have leaned on myself and intuition more than I had. And also back in 2014, 15, I started reading a lot more, and not only business, but self-help, personal development. And I think I've grown significantly, and it gave me the confidence to go off on my own and not worry about what other people thought, or not worrying about failure. Because if I do fail, every time I've had issues, I've learned more from my failures than any success, and just jumping out and taking that chance before I did.
What would you say is maybe the biggest, the most key failure that you feel like really kind of changed you as a person?
Honestly, it was that consulting job that I did not like. I was in it was E&P, which is exploration and production group. And in 08, 09, obviously the economy had tanked, and I got laid off from that job. Even though I hated it, I was expecting a couple large bonuses, and I was hanging on to it just for the financial security. And it opened my eyes up, and it was probably the best thing that happened for me, because I realized and towards the end of that job, I was given, I don't want to say this, but I was given a half-ass shot, and I'd never done that in my life, but I was just so fed up with it. I didn't really care at that point. And then from then on, I realized I don't care if I'm not given 110%. I don't want to stay at that job or place or whatever that situation I'm in.
So moving into, being able to have control, being able to choose how you're going to be, investing your time, investing your money, is what gave you that passion to put in that 110%?
Yeah. I mean, I've always liked to have control. I've always been successful at pretty much whatever I did, whether it's sports or academics growing up. And then outside of that job, I've been successful in every other job I've had. So I think it just made me reassess that I needed to take it seriously. And when I saw the stock market crash. Luckily, I was in grad school at that time, but then the previous job, I was putting together portfolios for clients, and I learned I had no control over the stock market. And I felt like with real estate, you can grab the bull by the horns and control your own destiny. Real estate is very local. Real estate might be doing poorly in one side of the country or one side of even the city, and it can be exploding in another. So I would rather trust myself and my intuition than relying on Coca-Cola or whatever stock to provide for my retirement.
What advice would you give to someone that is interested in getting into the multifamily space, but specifically the developer route?
I think education's key in every aspect, especially from a development standpoint. There's so many moving pieces that if you don't know it, you'll fail miserably. And maybe it's just the route I took. Is I think you should partner, especially at least on your first deal, with somebody that has done it before you and can show you the ropes. And even there's just so many moving pieces, and like going through planning and zoning with each city can be completely different, and they have different timelines and different requirements, and there's just a lot to take in. So being able to plan, be prepared as much as you can, because you're going to have to deviate from that plan, and just know that if you have somebody in your corner with you, then more than likely you can be successful.
And what's the best way that if anybody has any other questions or wants to reach out to Sam, what's the best way that they can reach you?
Yeah, definitely. You can call me at 972-855-7654, or I'm usually accessible to email, and it's sam@trinitycapitaltexas.com. I'm on social media, and I have accounts to social media, but I don't necessarily go to it that often. So email or phone's the best way.
Awesome. And I'll include everything in the show notes as well. But thank you so much, Sam, for taking the time and sharing your story. I think it's really, I think it was a really great example of, just someone that, it's not all just rainbows. It's not just like, oh, got my first property and now I'm, successful. It's like you've learned over these years, and your stories going through all of these different trials and figuring out the single family and the multifamily, and now doing development, which was completely outside of your comfort zone. I think it's a great story for you to be able to share. So thank you.
Yeah, well, thank you for having me on, Julian. It was awesome to get to share my story, and I feel like I might have dwelled on some of the mistakes and trials, but there's also been a lot of successes, and real estate has provided some things that I'd never imagined. Like, I now have contacts around the world that I can call any time of the day. We're actually, for the last year or two, we've been importing product from China and other countries in Asia, and got to go to factory cities and see how just the Chinese do business and a completely different way of life. And if I was at a 9-to-5, I would have never experienced that. So it is well worth it, and I'm going to stay and hopefully till I die in real estate. So I recommend anybody giving it a shot.
Thank you so much, Sam. We'll keep in touch, and we'll definitely want to see your progress as you move forward in the future.
Well, thank you. I look forward to it.
Hope you all enjoyed this episode. If you did, please go on over to iTunes and leave us a review, as that greatly supports the show. And if you'd like to be able to connect with John, the community, and I, then come and join us on our Facebook group, the Multifamily Success Network, where you can connect and make deals with other multifamily investors. Go to multifsuccess.com/community.